blue sky day out here in the Middle East. Talking about Bitcoin and altcoins. And is it going to be alt season following on the tails of the all-time highs Bitcoin has reached today, reaching into the 125K range? Are we going to see an altcoin explosion to the upside? Or is it just going to be more of what we always see, which is just the VEPs playing out? That's right. If you guessed the latter, you are correct. The markets move according to the VEPs. All these cycles people create, they say, oh, first the money goes into Bitcoin, and then it goes into gold, and then it goes into dollars, and then it goes into Ethereum, and then it goes into other altcoins, and then it comes back into Bitcoin. It's all nonsense. Okay. Are there times when there are more people buying or selling one particular asset class or another?
Yeah, they happen when they happen.
Are there times when they're buying a different set of asset classes than some cycle someone predicted? Yeah, it happens all the time. Literally all the time. By the way, they're always buying, the market is always buying and selling all of those asset classes that I just mentioned. They are all liquid enough that they are constantly having buy pressure and sell pressure. It's just a question of what do they have more of, buy pressure or sell pressure? There was always activity in these markets. So when people say, oh, it's the cycles like this, it's not like if you're in the Bitcoin part of their cycle, then you shouldn't be trading anything with altcoins or gold or fiat or whatever. You know, it's it's all nonsense. You trade every individual trade according to its own circumstances. Yes, there can be correlations that you can see between different assets and all this stuff, right? And absolutely, what the dollar is doing, will be an indicator. Like what Dixie is doing will be a very important indicator in terms of what the rest of the market is likely to do in one sense. Okay. And yes, we show that all the time in our workflows and alpha trading live streams. But you trade the actual trades you trade, right? So you get the information maybe from a bunch of different places. Sure. Like you know what's going on with the Dixie to know what's going on relative to, crypto, for example, or stonks or what have you. But you're not trading the Dixie when you're placing an order for a trade about Bitcoin or Tesla stock or gold or wheat or whatever, right? You're placing an order for those things. If you're trading Dixie, then yeah, sure, you're trading Dixie with the information that is most pertinent to Dixie, about Dixie, on Dixie. And again, yeah, sure, the other things that Dixie affects can show you some indications about what may or may not happen with Dixie. Absolutely. Right? That's why we look at VRE levels, right? They're great targets for taking profit. And Laplace levels and normal levels, right, in terms of distributions, right? So, what does that mean? Well, that means that we're not going to bias our trade based on not necessarily highly relevant information. It may be relevant in the big picture. It may even be highly relevant in the big picture, right? But you don't take a long on Bitcoin by looking last at the information on Dixie. Look at the information on Dixie in the process of deciding what to do with Bitcoin. But at the end of the day, as an example, if you're going to long Bitcoin at some low, hopefully, as you should do, right? Don't long it at the high, long it at the low. Like wait for it to dip and then reposition, and then if it's going to climb again, great. You're in a long from the low of that dip, right? Sell at the highs. Sell when the highs are saying you should be selling, which is usually right around the time they hit some targets at highs. And when you're in all-time high territory, you're just not making a mistake to cash out. Now, yeah, you can wait, whatever, but depending on when you got in, and how long you keep your trades open. Personally, I keep trades open an extremely short period of time because why keep the risk on an asset that is constantly distributing and mean reverting back and forth to the mean of returns. And it's doing so to the upside, to the downside, and sideways constantly. Why would I just, if you're just going to buy and hold, that's fine, but that's not trading, that's investing, or just holding, which is effectively investing, because you're holding in the hope, in most people's cases, if their mind is working right and they have a relatively normal situation, you're hoping the price of the asset you're holding will go up in time, in value, right? That's investing. Every investor hopes that what they're investing is going to be more valuable later. And if you want to call that a Ponzi, well, then investing is a Ponzi. But that's not how. That's not the definition of Ponzi, right? That's the definition of investing in an asset that you think the value of it will increase over time. That's all that is, right? Again, you want to say, well, that's just the greater fool theory. Well, then you can say that about literally every asset you can invest in. Okay, so if you want to just say that the greater fool theory invalidates all markets, good for you. I mean, I don't know what to tell you. Like, there is always going to be demand for stuff as long as people are alive. There's going to always be a supply of some amount of stuff as long as people are alive. Whether that stuff is relevant to their quality of life or not, it's all debatable issues, whatever. But basics are going to always be relevant. Like the money people use to pay for things, whether it's fiat or crypto or anything else, right? The things they pay for, like housing and food, utilities, etc., education, health, whatever, clothes, basics. So there will always be markets for those things. And that means as long as people are alive, right? And the resources are obtainable in any way, shape, or form. There are always going to be people who want those things, even if they can't get them, as long as there's people alive. And if there's no food for too long, ain't gonna be no people alive. So that's kind of like, the critical one: no food, no water, no people. So you know, that's why you have to look at these things, these kind of bull cycle, bear cycle, altcoin season, crypto season kind of cycles. Gold, fiat, commodities, seasons, and cycles. You have to view them with more than a grain of salt. Okay, it's like you gotta take them with a deer lick, right? If you ever seen a deer lick, you know what I mean. Those things are big chunks of salt, big huge rock salt, big salt rocks, whatever that you put out for deer, and it's just another device that is used to deceive people with misinformation and misleading information, which is lagging information, right? Like, it doesn't matter if you're intraday trading. It doesn't matter if you're in an alt season or a Bitcoin season or a gold season. None of these things matter. These are all distractions. Right? Hello there. I see you. I see your message. None of these things actually matter in a practical sense. What matters in a practical sense is that um, intraday you make decisions on your trading based on low time frames. Right? Who cares if you're trading intraday? Who cares if Solana might go to $300 in the next month? How that doesn't help you today, right? Because such a high time frame prognosis, right, or forecast, it could be correct and has way more probabilities of not hitting that exact number. Can we agree on that? Like, if I'm saying, yeah, Solana could hit $300 this month, guess what? It could also hit every other target between here and there. And it might also go in the other direction, hitting targets below, right? And it might also go above 300. there are probabilities all over the place. So sure, you can show specific probabilities like first standard deviation, second standard deviation, third standard deviation, or Laplace distributions, or VRE levels, or RMLR targets, or whatever you want, power mean targets, reverse wave trend, no matter what. But on such high time frames, you would be foolish to place what ought to be a low time frame trade um, with that, based on that information about the high time frame, because it's just not going to help you. It's just not going to help you.
The low time frames are where the juice is at, so to speak.
That is where you go to find what is actually relevant to your trade. Is the 30-second showing the asset far below or far above the power mean ribbon, the reverse wave trend, a particular VRE target, or a distribution target, normal distribution target, or Laplace distribution target? Is it in a trend? Is it in a random walk? Right? If it's in trending move, it's a lot easier to kind of know what's going to probably happen next, especially if the trending move is just starting and has even confirmed the candles now, like in the second candle, like guns blazing. It might have even been very obvious it was going to be a trending move for a couple of candles before, as the entropy was expanding, right? So a lot of these different things you can look at on low time frames, which, by the way, the same things you look at on the high time frames, but on the low time frames, they actually tell you where to get in and get out in the moment, and so that you're not stuck to your trade for hours, let alone days, weeks, months, or years. And by the way, most exchanges, like centralized exchanges, especially if you have like a small account, they really will end your trades at some point if you're in a loss, or even if you're in a gain. Like if you think you can just run a trade and let it run for 10 years, it's the probability is your trade is going to be closed at some point by the system, right? And whether you're in a loss or whether you're in profit, and it usually won't take years for that to happen, right? Usually take far less time, right? It could be a matter of months, weeks, or even likely days. Yeah, sure, you can keep a trade probably running for a couple of weeks, maybe a month, depending on the position and how much you're in the profit or how much you're in the loss. They might do that, but it's also entirely possible for an exchange to accidentally burp and kill your trade. It's like a server fart, whatever. Something happened and your trade got closed. These things happen, and they will not give you your position back, unless you can prove that it was somehow malicious intent and all this other stuff. And good luck with that. So yeah, again, is it alt season now after the Bitcoin all-time high? Well, first of all, the Bitcoin all-time high, yippee do. Are we going to see it hit 150, 250K by the year end, maybe higher, 250,000 by the year end? Again, same thing. It's look at the lower time frames. That's where the changes happen. That's where you get in and out of trades. If you want to actually beat the market and you're a serious trader, not just a lazy, I'll throw $50 at the wind and put it on 500x leverage or something crazy, and I'm just going to, basically lose it the moment it moves a tick against your direction, right? Which is what a lot of degens do. They put on however many X, like over on
What is that site called? Aster?
a competitor to Hyperliquid now. What do? They give people up to 300x leverage to trade on their platform. So if you want to trade like Hyperliquid on Aster, you can trade at the 300x leverage. Think about how crazy that is. Think about just how insane
It is to offer somebody who shouldn't be trading,
who doesn't know how to trade leading information, doesn't even know what leading information is, to offer them to trade with 300x leverage on a token of a competing platform to your own platform. Think about how insane that is. Basically, what you're doing is you're yanking on their emotions, 100%. Psychological stuff, emotional stuff. You're pulling on their strings, and you're drawing them to make terrible trades if you're that exchange.
But they're doing it because they know people will continue to put money into those systems. They know people will continue to gamble in that way because they figure, people figure who are gamblers, they figure, well, you know, yeah, I'm probably going to lose this trade. But if I win, then I multiply my money easily. But the problem is, of course, they're not going to win. So they're going to keep doing that until they lose all their money. And yeah, they might do it by one small attack on their account at a time. But ultimately, that is what happens, right? These companies are taking their money very easily because they offer such ridiculous amounts of leverage. Like, you think about it, if you're offering more than 100% leverage to a crypto trader, that means you are literally offering them a get wrecked card. And that's exactly what's going to happen. And why? Because they are going to put money with extremely high leverage, which means if it moves, at 300x leverage, if it moves 0.3%, and even less when you factor in all the fees, etc., if it moves 0.3% against them, they're wrecked, right? Or a third of a point against them. Right? But it's even, again, like I said, it's even less than a third because of all of the fees. The exchange fee, the trading fee, the liquidation fee, right? There's maybe even a network fee depending on whether you're using a SEX or a DEX or whatever. You're going to go belly up basically the moment it moves in any direction, right? Meaning, even if it goes your way for one candle, even like it moves up a half a point and you're like freaking out, you're like, holy crap, it's a half a point up, I'm like 250 points in profit or whatever, and then the next second before you take your profit, it just shoots down 1 point and now you're wrecked. Or it shoots down not even a point, it shoots down 0.7% and you're wrecked. You don't think that can happen in crypto? It happens literally all the time in altcoins and crypto. Like literally all the time. That's my point. Is don't get yourself wrecked doing things like that, right? But there are people who will. Because they're sure they're going to get the absolute bottom. And you know what? Once in a lucky gambler will get it. And they'll be the poster boy for you could be a millionaire like, this guy or a girl or whatever, gal. So that's why you got to be extremely careful when you're taking out positions in crypto. Like, you know what? If you want to piss away money, to put it politely, on a kind of a lucky gamble, and you put away, you put $1 or $5 or $10 once in your life just for funsies to see how quickly you'll lose it, and you can afford to lose $1 or $5 or $10, why not go right ahead? See how well you do. Okay? The probability of you getting it absolutely right and not losing that money and putting in a massively profitable trade that turns into a fortune is extremely small. Okay? Unless you're literally at the outset of a brand new market, brand new asset class, or a brand new asset that you are fully convinced is going to have a very bright future and you are getting the absolute bottom and it's never going to go lower than where you at by even like a third of a point, then, hey, good luck to you and have fun with the gamble. But just keep in mind, you're probably going to lose, right? And that's why you don't put in a big amount on that kind of insane risk, right? It's just not worth it, right? It's too risky because the probability is it will go against you. You will lose that money. If you think you won't, by the way, if you think your money is too small to be targeted, I remind you, no, it's not. You can have $500 in your account. You can have $100 in your account. They're still targeting you because you're part of the greater pool of targets
that have targets for entries and exits and stop losses and liquidations set in similar areas, because there's other people putting in entries just like you, making foolish decisions just like you with different position sizes, etc. And they're using maybe similar bad information or maybe other bad information, but they are using bad information, and that's why they're going to get wrecked. And they're applying poor risk management, which is ultimately why they're going to get wrecked. Because, like I said, if it breathes in the wrong direction against you, if you think a shitcoin can't move 0.2%, just go look at the 30-second candle of anything in the alt meme coin market. Even the solid ones move 0.2% in a 30-second candle easily. Like that's not even that's just normal. Yeah, they can move less, but they can also move way more than that in a 30-second candle, right? They can easily move a percent. Altcoins can easily move an entire percent in 30 seconds, easily. Sometimes more. Depends on the asset. But in some cases, I've seen assets go up, 1, 2, 3, 4, 5% in the 30-second candle. It happens, and they can come right back down, right, in that same amount of time or less. So just because it goes up quickly doesn't mean it can't come down just as quick or quicker, and vice versa. Just because it goes down hard, real fast, does not mean it can't bounce right back up just as hard or faster, right? And yeah, a lot of time you'll see when it crashes hard, you'll very often see that it's that it's going to come back up halfway, or when it shoots up real high, it's going to come back down about halfway before the next move, right? That happens all the time. But that isn't always the case. Sometimes it comes down all the way from the move it made up, or sometimes it goes back up all the way from the move it made up, and it continues. Like you get a lot of these fake outs in one direction and the other before it actually starts making the move. Sometimes it'll do back and forth, back and forth, back and forth. For what? Why? Because you're literally having a lot of buy pressure and sell pressure in those moments. There's just a lot of buy pressure and sell pressure. A lot of people want to get in on a move that they think is going to be the right move. What do you do in that sense? Well, in that sense, if you have a high degree of uncertainty, if the calculators are telling you the probability is not very clear which way it's going to go right now, you should wait until you make the trade. Then you should wait until you make the trade. You don't need to rush into it. It needs to be clear. It needs to be obvious. It needs to be evident as the sky is blue on a good clear day. Right? The opportunity, right? The occurrence of opportunity should be clear 100%. Otherwise, why enter it? And is it ever 100%? Yeah, it is. I mean, like 100% meaning like you should be seeing your main indicators telling you it's a go in one direction or the other. Right? If you have at least 3 of your primary leading information indicators telling you it's a go in one direction or the other, it's probably a go. Right? That's about as close to 100% as you're going to get. Okay. If more than 3, if like 4 of the primary leading information indicators are telling you to go, this is super. But like when you find 3, you will probably find more, whether with other primary indicators or with secondary indicators or tertiary indicators, etc. So the more confidence you find, the better, right? And the point is, generally speaking, when you see confluence across 3, at least 3 primary leading information indicators, then that is how you can basically tell if it's time for a go move, right? What are those primary leading indicators? Well, if you watch Alpha Trading, you'll know that the primary leading indicator uh, or leading information indicators include volatility, entropy, COV, RO, right, returns oscillator, right? And also like VRE levels, right? Laplace distribution and normal distribution levels, right? Those are targets for where the asset should go before you close the trade, right? And you can use other ones too, like the RMLR ones, etc. But like at its core, those 4 that I mentioned first, volatility, entropy, RO, and COV, those are like your 4 basic you know, primary leading indicator to use to make that determination. If you want, like from the point of view of somebody who's using all the tools properly. Anyway, of course, the starter pack has a slightly different set of tools, but they're still very valid. And so, highly recommended you learn that because it's volatility, AVQ, and ALR, which is perfectly fine to learn how to trade volatility. It's just you don't have entropy, and you don't have COV and RO, but you have ALR, which is close to RO, and you have COV. I mean, not COV, and you have AVQ, which is very good for knowing when to enter and hold and get out of trades also. So it's great for targeting. Anyway, and direction. Anyway, that'll do for now. I'll talk to you guys later. Wait, I don't see what all this is supposed to. Okay. All right. See you guys later. Bye.